Hey everyone, welcome back to Corporate Decoder, the place where we break down the dense financial reports that shape the business world. And today we're diving into Franklin Managed Trust's latest SEC filing about their Franklin Rising Dividends Fund. It looks like this fund had a pretty interesting year, with some ups and downs we'll unpack. Before we dive in, if you appreciate getting straight insights from complex corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these filings and more. Alright, let's get started with what this filing is all about. This is an annual shareholder report for the Franklin Rising Dividends Fund, covering the period from the 1st of October 2024 to the 30th of September 2025. Essentially, it is a yearly checkup on how the fund performed, what costs investors faced, and what exactly the fund invested in. Now, nobody likes talking about costs, but it is crucial for understanding your investment. For a hypothetical $10,000 investment in class of shares, the costs for the last year came out to about $85. That is 0.82% of your investment. The report notes that these figures reflect fee waivers and expense reimbursements, meaning without those helpers, the cost would have been even higher. It is like getting a discount on fees, which is always good to see. Here is where it gets really interesting. For the year ending the 30th of September 2025, class of shares of the Franklin Rising Dividends Fund returned 8.35%. Now that might sound okay, but the fund compares itself to the S&P 500 index, a benchmark for the broader US stock market. And guess what? The S&P 500 did much better, returning a hefty 17.60% during the same period. So, while the fund made money, it significantly underperformed its benchmark. Let's look at what drove some of this performance, both good and bad. On the positive side, stock selection in the financial sector did well. Companies like Morgan Stanley apparently climbed to all-time highs thanks to strong earnings and confidence in their strategies. Big banks also benefited from higher trading fees during times of uncertainty. Another big contributor was Oracle, the enterprise cloud software provider. Its shares surged because of massive demand for its cloud infrastructure and a strong backlog and revenue forecast. And then there is Broadcom, a semiconductor and software giant whose shares nearly doubled. They're seen as a cost-efficient alternative for custom AI chips, which is really boosting confidence in their long-term AI strategy. But what dragged the fund down? A big reason for underperformance was a lack of exposure to some of the hottest tech stocks. Think chipmaker Nvidia, Google's parent company Alphabet, and Tesla. These companies shot up, but they did not meet the fund's criteria for dividend screens, meaning they don't pay out enough dividends for the fund to invest in them. It is a classic trade-off between growth potential and dividend payouts. Also, insurance giant UnitedHealth Group was a major detractor within the fund's holdings. Higher medical costs and rising expenses in its Optum Health division squeezed profits. Adds to that some leadership changes, including the unfortunate murder of its CEO and conservative earnings guidance. And investors got nervous. Consulting firm Accenture also made the list of detractors. After reaching highs driven by AI and digital trends, its shares declined due to weak bookings, soft government contract trends, and concerns about restructuring costs. Looking at longer-term performance, the fund's past results are important, though remember, past performance does not guarantee future results. The value of a hypothetical $10,000 investment in class of shares without sales charges grew to over $9,400 by the 30th of September 2025. This represents a 12.55% average annual total return over 10 years. That sounds pretty good. However, when we compare this to the benchmarks, the Russell 3000 index returned 14.71% annually over the same decade, and the S&P 500 index returned an even more impressive 15.30%. So, even over a decade, the fund has lagged behind the broader market. Focusing on the numbers for the year ended the 30th of September 2025, class of shares returned 8.35%. Over 5 years, that is 11.75% annually, and over 10 years, it is 12.55% annually. Compare that to the S&P 500 index, which saw 17.60% for the year, 16.47% over 5 years, and 15.30% over 10 years. The gap is clear. What is interesting is the classes A with sales charge, which show a significantly lower return, highlighting the impact of those upfront investment costs. Let's glance at some key statistics as of the 30th of September 2025. The total net assets for the fund were a staggering $28,217,936,697. That is a massive amount of money. The fund holds 56 portfolio holdings, and the total management fee paid was over $133 million. The portfolio turnover rate was 11.20%, meaning the fund bought and sold about that much of its holdings during the year. Now, what did the fund actually invest in? The filing shows a breakdown of the portfolio composition as of the same date. We see common stocks make up a whopping 98.9% of the total investments. Looking at sectors, semiconductors and semiconductor equipment were a big chunk at 10.7%. Followed closely by software at 15.3%. This shows a strong tilt towards technology, which explains some of the performance swings we saw earlier. The report also lists specific companies like Microsoft, Apple, and Oracle, which are all tech giants. This section reveals some important strategic shifts. On the 1st of February 2025, the fund revised its principal investment strategies to reflect an increased exposure to the technology sector. This aligns with what we saw in the portfolio composition and explains the fund's performance drivers and detractors. They also added disclosures about the risks of investing in this sector to their prospectus. Now, this report covers a few different classes of shares within the Franklin Rising Dividends Fund Class C, Class R6, and Advisor Class. While the overall strategy and top-bottom performers are similar across the board, the costs and specific returns vary slightly due to different fee structures and sales charges. For example, Class C shares had higher costs, paying $163 on a $10,000 investment, coming in at 1.57%. Their performance also trailed slightly at 7.54% for the year. Class R6 shares, often found in retirement plans, had the lowest costs at just $53 for a $10,000 investment, or 0.51%, and posted a solid 8.68% return. The advisor class also had low costs at 0.57% and returned 8.61%. Moving on to other important details, the report mentions fees paid to their principal accountant, PricewaterhouseCoopers LLP. For the fiscal year ending the 30th of September 2025, audit fees were about $48,369. They also paid $10,000 for tax services. It is good to know these reports are independently scrutinized. This section confirms that PricewaterhouseCoopers LLP has audited the financial statements and believes they present fairly, in all material respects, the financial position and results of the fund. They'd been the auditor for Franklin Templeton grouped funds since 1948, which shows a long-standing relationship. Let's dive into the notes that accompany the financial statements. One key point is about how the fund values its investments. They use a fair value hierarchy that distinguishes between easily observable market data and more subjective internal assumptions. For the most part, the fund's investments are valued using level 1 inputs, which means they're based on quoted prices in active markets for identical financial instruments. This is generally the most reliable way to value assets. Interestingly, the fund invests in other affiliated management investment companies. This is common, and what is noted is that management fees paid by the fund are waived on these specific assets. This is to avoid double charging investors. The report details that for the year ending the 30th of September 2025, the fund held about $332 million in these affiliated money market funds. Looking at the financial statements themselves, the statement of operations details the fund's income and expenses. For the year ended the 30th of September 2025, total investment income was over $450 million. Expenses, including management fees and distribution fees, were over $212 million. After accounting for waivers and reimbursements, the net expenses were around $211 million. The fund generated a net investment income of over $239 million. Importantly, the realized and unrealized gains from investments added nearly $2 billion to the net assets. The statements of changes in net assets show the movement of money in and out of the fund. For the year ended the 30th of September 2025, there was a net increase of over $2.18 billion from operations. However, distributions to shareholders totaled over $2.57 billion. Overall, there was a net decrease of about $661 million in net assets for the year, bringing the total net assets down to just over $28.2 billion from about $28.8 billion the previous year. This shows that while the fund generated strong returns from its investments, shareholder distributions and redemptions outpaced that growth. This is a snapshot of the fund's actual investment holdings. The common stocks section alone shows investments valued at over $27.9 billion. The largest sectors are software at 15.3% and semiconductor equipment at 10.7%. Within software, Microsoft is a huge holding valued at over $2.6 billion, and Oracle is also significant. On the semiconductor side, Broadcom is a major player valued at over $1.5 billion. Now, let's step back and look at the broader picture here. Franklin Rising Dividends Fund, despite its name, has shown a consistent pattern of trailing behind its benchmark, the S&P 500, over both the short and the long term. This is largely because its investment strategy, which focuses on companies with consistently rising dividends, means it misses out on the huge growth seen in many tech companies that don't pay significant dividends. While this might offer some stability in down markets, it has clearly cost investors returns in strong growth periods, especially with the rise of the Magnificent Seven tech stocks. The fund's shift to increase exposure to the technology sector is a smart move to try and capture some of that growth, but it also amplifies the risks associated with high growth. Volatile tech stocks and potentially moves it further away from its original dividend-focused strategy. The sheer size of the fund, over $28 billion in assets, is impressive, but it also means that generating significant alpha or outperforming the market becomes increasingly challenging for investors. The key question is whether the fund's dividend focus provides enough downside protection and income stability to justify the underperformance in growth periods. In conclusion, Franklin Rising Dividends Fund is a large and established fund with a clear investment philosophy. However, its performance relative to the broader market raises questions about its strategy's effectiveness in the current investment landscape. While it aims for stability through dividends, it has consistently lagged behind in periods of strong market growth driven by technology. Alright, that is our breakdown of this filing. What is your take on these numbers and what they signal for the Franklin Rising Dividends Fund's future? Do you think their tech focus will pay off or will they continue to lag? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate financial world. And don't forget to check out the Discord community linked in the description for more discussions. Thanks for watching, see you next time.